What's going on, everybody? You're listening to The Gray Report. I'm your host, Spencer Gray, and I'm joined here by Matt Bosnagel, Director of Communications and Marketing at Gray Capital. If you are a multifamily investor, a real estate investor, maybe you're thinking about getting into the business, or you are already in the trenches, you are an industry insider, well, this is the show for you. It's all about figuring out what's going on in the industry so you can have the most up-to-date information, data, insights into the latest research on the multifamily industry, real estate, and the economy. That way you can make some really good, intelligent decisions. Again, whether you are working in the multifamily industry or you are an investor, or again, if you're just trying to figure out this entire space out, this is all for you. We've got three great reports. We've got reports from Berkadia, Marcus and Millichap, NAR. Let's get into it, Matt. All right, back on the Gray Report. Matt, this has been an exciting couple of weeks.
Yeah.
There's a lot of momentum. We've got a lot of cool things just in our pipeline, but also, again, this economy over the last 2 years has been crazy, but this last month or so has been kind of a wild ride, whether it's in the stock market, commercial real estate. But how's your week been going, man?
It's going pretty good. You know, it snowed a lot last week.
Yeah.
And then it's finally thawing. And I think... I keep thinking of ways that the economy may be heading in the wrong direction.
Yeah.
And I'm trying to find a real compelling reason to be pessimistic, but I can't yet.
Well, you can find something if you look hard enough.
It's
and
true.
With reports coming out, there's a lot of seasonality.
Yeah.
And I've seen a lot of reports and a lot of opinions based on seasonal reports that have painted things in a negative light. But it's really, it's like, that happens every year. We're kind of regardless of the strength of the economy. There were some rent declines in December and a little bit in January in a lot of markets. But as we were breaking down whether it's that apartment list report or other reports, seeing these are really just seasonal differences that are to be expected to help filter the noise. And again, that's kind of why we do this at the Gray Report is let's filter that noise. Let's break down what's important, what's real, what you need to be concerned about, and what is something that you don't need to worry about. It's not worth their energy.
Well, and that's in a lot of the stuff that we're going through today really outlines like an ideal kind of Zen mindset for the apartment investor that really isn't affected by the daily vicissitudes and the turmoil that you see on day to day. You can really lose sight of things if you're not in the right mindset.
It's worth taking a deep breath sometimes.
That's right.
And just figuring it out.
Yeah.
Not getting emotional about it. And again, that's what we're here to do. And just, it's interesting. Yeah. Something might look negative one day, but then there's the other side to the coin, whether that's wages, employment, where the market's going. I still think, and I'm not trying to make a call here, but I think we're in a much more, we're in a kind of a post-war economy, I think. We're not even really out of the war, but just about post-war economy. We're going to see strong growth, and I think it's going to be more like the 50s than the 70s, but we shall see. Yeah. And I am not economist. I just play one on YouTube and a podcast.
That's right.
But I do buy a lot of real estate. So, all right, and Matt, we just got back from a property tour. The market's interesting right now, and again, just a lot of stuff in the pipeline that we're excited about at Gray Capital. If you're interested in kind of following what we are doing at Gray Capital and on the Gray Report, highly recommend make sure you're subscribed to the Gray Capital YouTube channel. Give us a like, a comment, give us your opinion, tell us that we're wrong or we're right sometimes. But then hop on over to graycapitalllc.com. You can either sign up for the Gray Report newsletter, join the investment club, learn about the Gray Fund if you're an accredited investor, all that good stuff. In general, we'd love to get in touch with you and see what you are up to. But let's just hop into this first report from Berkadia. Interest rates, stagflation, inflation, and monetary policy. It seems like everybody's talking about the Fed right now.
Yeah.
It's obviously, which is for good reason.
Yeah.
Who can move the needle? It's
nice when we have a confluence of some of the reporting that comes out because the Fed is a perennial subject of long-term attention, and there's been reports from Berkadia. There's also been a short video that Marcus and Millichap that released that covers roughly the same subject.
Yeah.
And I want to go through this one also because we have an upcoming interview with the Berkadia Thought Leadership team next week. And part of this is what we'll cover in the interview. But there really is enough in this study that I can be digging as much as I can into this. And it'll still be just a teaser for what
I was going to say, we got to save the good stuff for Jonathan and Noah. But also, as you said, Matt, we got this is a
well. Good news is there's a lot of stuff in here that it takes me a few minutes to wrap my head around, and so I think our average listener will be fine. But I got to do some thinking time. Fortunately, though, at the start of this report, the authors Jonathan Rappa and Noah Stone have a solid breakdown and explanation right off the bat. They have this executive summary that the first point of which is that monetary policy changes take 5 to 6 quarters to actually have an impact on leveraged apartment returns. Yeah, there's that first page there. Now, this may not be a huge surprise to people, and it's likely something that you'll find out if you throw the numbers in a spreadsheet. But the reporting on monetary policy, and to extent the feeling in the multifamily markets, we heard back from those surveys last week. Everyone, their chief concern in I think even Berkadia's Powerhouse poll was inflation policy, monetary policy. How much is that going to affect the market? Yeah. But so with that in mind, though, even so, there's this feeling that the monetary policy has so much more immediacy, how there's going to be this instant effect. But what they're saying here is 5 to 6 quarters. That's going to be a year and a half before
maybe in the stock market. Public equities market that are forward-looking indicators. Real estate is a lagging indicator. That's for sure. Which again, that's why real estate is so exciting, is because you can exploit these inefficiencies. You can use indices like the stock market or the bond market just to get an idea of kind of the general sense of the economy. And then real estate moves so much slower. You can have an idea of the future to make some different interesting calls, whether for good or the bad. And that's what I love.
Yeah, and that's what I think also is interesting too, is because I think there is a difference between the survey answers and the actual actions and behavior of the market, which represents real decisions people make with money rather than just kind of speculation. When money's on the line, it does seem like there is a more a calmer attitude, a more rational and coherent rather than volatile and kind of frenzied reaction to monetary policy decisions.
But let's talk just realistically and practically about the mechanics of what would cause the market to move, specifically the commercial real estate market. The Fed moves, and let's again dial in closely what exactly we're talking about. It's a handful of things. We're talking about quantitative easing back and eventually eliminating the purchasing of mortgage-backed securities and treasuries, which again is insane. So the economy is running so hot, apparently running so hot. Inflation 7%. CPI is 7%. There's other metrics that are significantly higher than 7%. Yet, the Federal Reserve, central banks around the world, for the most part, some have turned it off recently, are still engaging in quantitative easing and completely loose monetary policy. On one hand, they're saying things are running too hot. On the other hand, they are buying mortgage-backed securities and treasuries, adding more liquidity to the system. So that's one part, is that they're going to be tapering back the purchasing of
so it's going to be less money to go around,
less liquidity in the system, so that there's less people or the Federal Reserve is no longer going to be purchasing mortgage-backed securities. If you go out and you get a loan, whether it's an apartment building or a house or any type of commercial real estate, those loans are bundled up as securities and sold off to bond investors who are looking to get a consistent income. Whether you're an individual, you're buying just a single note. Now you're not securitizing that, but it's the same concept. Individuals looking for fixed income, and with the idea that housing is relatively stable. Now that mentality is what led to the great financial crisis back in 2008. Now the lending standards are completely different, so we're not looking at the same problems, but they're injecting liquidity, making sure that lenders have plenty of buyers for these bonds, because you're not going to you're not going to make a mortgage and lend on a house or an apartment building if no one is going to buy that bond for you, because they're going to make the money on the servicing of the loan. They want to originate it, and they're going to sell it off, and it's going to be securitized. So adding that liquidity knows that, hey, let's keep making loans because there's always a buyer, and they're buying a ton of them.
So that keeps the rates for loans lower, because they're injecting so much liquidity?
It keeps the rates slightly lower because they have to deal with volume. They can loan so much, but if they raise rates, then it's going to be harder to lend. And so they're just going for volume right now. But they know that they can issue as many loans as they want. They're not going to have a problem saying, I don't know if I'm going to write this loan because is there going to be a pool to securitize this loan at the end of the day? So it's excess liquidity, not necessarily. It can impact interest rates in the sense that they're buying the bonds. So when you buy the bonds, typically that raises the price.
Yeah.
You're buying more of something. The supply is low, demand is high, price goes up. And bonds, when prices go up, the yield lowers. So you are reducing the interest rate.
But that's an indirect effect.
It's an indirect effect just because it's a market force that the Federal Reserve is meddling in. Because usually it would just be normal buyers of mortgage-backed securities and treasuries. Now the Fed is in. They're the major player. They can move the market. And if there's always a buyer, those prices are going to go up and up and up.
So then for the multifamily investor, just typical investor, what would he, if he could buy and sell, if he could freak out, and they are freaking out, and a lot of this report is about leveraged returns too. So that's directly what you're thinking about. What is he scared of when the Treasury announces, or when the Fed announces that they're going to reduce their bond buybacks or their asset purchases?
So that's a good question, and that's going to get kind of the second piece in one of the other levers, which is really kind of monetary policy. It's really monetary policy. One is actually moving the interest rates. So just on the buying of securities, that's not going to mean that much to a multifamily investor, other than okay, maybe is there going to be less liquidity? Maybe, but there's still a ton of liquidity because people want to buy bonds backed by U.S. real estate right now. There's still plenty of buyers in the market. What's more concerning is not necessarily directly concerning, but of issue and of where it could affect the market is, when the Fed actually moves the Fed funds rate. Now, some people, they can move other interest rates by buying U.S. treasuries, selling treasuries, the same way we were just talking about. So if they sell a bunch of treasuries, well, that price is probably going to go down, just like you sell anything, and that rate is going to go up. So if they wanted to move the rate of the 10-year treasury up, they could just dump all their 10-year treasuries. And theoretically, that would make the rate rise, unless there are so many buyers out there buying 10-year treasuries, which that's the thing. There are the U.S. 10-year yield, which is, on the Gray Report, between 1.7 and 1.8 right now. Most other 10-year maturity, government-backed bonds are still negative. So I can invest in a U.S.-backed treasury, which U.S. is the strongest economy in the world. Backed by however many super nuclear aircraft carriers and 3,000 nuclear warheads. You can get paid 1.7 some percent, or I can buy German Bund, which nothing wrong with Germany, but they're dependent on Russia, for their energy. We're not comparing U.S. and Germany, but you're going to get negative rate on your 10-year. So there's a lot of international demand for U.S. treasuries in general, and just U.S. assets in general as well. And so the way that the Fed really moves interest rates, the only thing they technically control, they can influence these other rates by buying bonds. But it's the Fed funds rate in the overnight window, which is like the shortest term interest rate, and it's been basically at zero or 0.025 for the last couple of years. And what that does, it's essentially the floor on other short-term, on all rates and all other short-term interest rates. Because then the next short-term interest rates that we're going to be watching, where multifamily investors need to be paying attention to, are the SOFR rate. And formerly it would have been LIBOR, the 30-day LIBOR. Now LIBOR has been being phased out. It has really been phased out. I mean, there are still loans based on LIBOR, but all your new kind of bridge loans, variable rate loans, floating, they're all based on this 30-day SOFR rate, which has been stuck at like 0.05% for like the past year. It like hasn't moved. But so when the Fed funds rate moves beyond 0.025, so you're at like just a 0.002 5% difference right there on SOFR. But when the Fed funds rate moves, and they're talking about maybe half a percentage point or 50 basis point, that SOFR rate is then going to move. It would be hard to imagine that this rate of SOFR would be below the Fed funds rate, because there is theoretically more risk in SOFR rather than the Fed funds.
Yeah.
And so what that does and what that means is it raises the cost of borrowing for lenders. Just like if you're buying a house, your cost of borrowing, your interest rate's going to go up. It's going to increase your debt service. The deal is going to get skinnier, and so that's where multifamily investors, one, if they're looking at acquisitions, and they've been using we have been using, okay, let's figure a 3% interest rate or 3.25% interest rate, seemingly normal when we were getting quoted 2.75%. Okay, rates go up, we get 3.5%, it'll still work. But now it's like, okay, well, now maybe it's going to be 4%. Yeah. So that's going to change our underwriting standards to say we're going to bake in rates moving over the next year. So maybe we can't pay as much for that property. Now, on the other side of that, you have rents that are continuing to grow that in some way are offsetting, but it is adding headwind to the acquisitions process. Whereas last year, rates are all sub 3. It was a tailwind, because it was like, this debt is so cheap. It's at as we stated, at a 5 millennia low. Let's lock in this debt while we can. Yeah. And while growth is really hot too, it was kind of like run on all cylinders. It's like a sweet spot of high growth and low rates. It's incredible.
Yeah.
But so for current investors, so on that's on the acquisition front. But if you have a current multifamily property or an investment that is backed by a floating rate loan, you're going to be watching this, because your interest rate should be rising as Fed funds rate rises and SOFR rises. And in general, the anticipation of volatility. Because, if there's been one buyer in the market that has been dominating the space and they all of a sudden are gone, do other buyers show up? Well, they're there, but we don't, again, it's uncertainty. We don't know, which can lead to volatility, which could then lead to the lenders playing with their spreads. And so the spread is the difference. It's a profit essentially that the lender makes between the interest rate that the loan is based on, and then a certain percentage points above that where that's their profit. So SOFR is at 0.05, like I said. So let's just call it 0 for ease. So basically 0. So the bank is borrowing at 0. They want to make some money on it. So they're going to have a spread of 300 basis points or 3%. So they're going to make 3% on that. Your rate is going to be 3%, even though it's based on SOFR plus a spread. And so based on the risks in the market, volatility in the market, and I don't know I'm not familiar with all the ins and outs, because it can be somewhat complex of really seeing where the bond market is going. And then the demand for investors and demand for bond purchasers, going back to the Fed buying up all these MBSs, mortgage-backed securities. If the demand goes down, they may extend their spreads, because they're saying, look, if you want to borrow money, we're less certain on who's going to buy this mortgage at the end of the day. We want to make sure we're getting paid for the appropriate risk we're taking. There's appropriate risk premium. So instead of charging 300 basis points, we're going to charge you 350 or 400 or whatever it is. So you have interest rates that are moving, that are increasing, are raising the floor, but you're also having this risk and volatility that the lender is pricing in, which could balloon rates even more. So instead of from lending, getting sub 3 rates, all of a sudden we could be in the 4.5, even 5% interest rates before we know it. Now you can purchase interest rate caps, which we do when we typically do get a variable rate loan, so the top that you're going to pay. But all of this is, it's uncertainty.
Yeah, it's like a contagious uncertainty almost.
Yeah.
Okay, so that's a really good context, and so I kind of want to explore a little bit about how Berkadia deals with this and how they use that as a little bit of a jumping off point. So yes, their first point in their summary is that these monetary decisions take a while to really trickle and impact the apartment market. Their second point, and it also finds that real apartment returns perform better than equities during times of quasi-stagflation, and leveraged apartment returns remain stable during periods of high inflation. Finally, and this connects to their first point, the study notes that market response to the Fed's taper tantrum was effectively overblown, and the Fed's wind down of asset purchases will have a lessened effect that will likely subside relatively quickly, quicker than you think. I think that it's with this summary, Jonathan Rappa and Noah Stone really they effectively send the message of basically hold your horses.
Well, keep calm, carry on.
Yeah, exactly.
Is what it sounds like.
There's a lot of follow the Fed sentiment up there, almost probably an over-reporting of all of these indications from the Fed. But Federal Reserve monetary policy decisions are probably not going to disrupt the economy, not the way that some people are thinking.
Well, they have been the ones that have screwed things. They're the ones to screw it up. They're the ones that have screwed it up in the past. Yeah. And so they will be the ones that screw. Like, that's fine for right now. Mm-hmm. It may not be this year, it may not be next year, but most likely it is going to be an overreaction, an underreaction. The Federal Reserve will screw things up eventually. Give them enough time. And I'm not trying to.
I'm just trying to summarize. I'm trying to characterize the point of this paper.
Yeah.
And not
this
say that it's fine.
Is not going to screw things up. That's fine. Eventually.
So, what I was wondering then, so if it's not really the Fed or monetary policy making that kind of impact, what should we be watching? And they really do point to, they say, keep a close eye on the 10-year break-even inflation rate. The 10-year break-even inflation rate is based on real bets that are being made with real money about where inflation is going to go in 10 years, rather than the CPI expectations that maybe fluctuate more, that are less grounded and have less implications than really when people put money on the line. It's just like what I was saying before. There's, you can release a survey of multifamily professionals, or you can tell them to put their money on the line. I'll tell you, they'll turn to their spreadsheets a lot more when they put the money in the line, rather than getting this vague feeling that may be more indicative of emotional.
And so the 10-year break-even inflation rate, so we're just below 2.5%. Now, it was sub 2% for quite a long time, and it's interesting. What I like to do sometimes is compare the 10-year break-even inflation rate to the 5-year break-even inflation rate, kind of see what that difference is. I don't know if they have a chart that specifically shows that, but to tell us more. So, what are they looking for? They're in the 10-year break-even rate. They're just saying as a better.
So what they're saying
snapshot
is, they say
the future and
commonly
future
understood is the positive relationship between inflation and yields, but too often is actual inflation assessed over inflation expectations. And they say that an above average rise in either actual or expected inflation is likely to lead to an above average rise in yields in the same period, with the stronger relationship existing between expected inflation and yields. So this isn't necessarily the expectation of it. Inflation has a stronger impact here than actual inflation, which is not kind of some off the wall idea.
No, we've been talking about that quite a bit.
Yeah, CRE investments are like multifamily properties in particular. They're necessarily forward-looking endeavors, and they'll succeed and fail based on people's ability to think 5 or 10 years in the future. Yeah. And we were kind of hinting at this before with REITs as an exception. Multifamily investors are buying something that they're not going to be selling or not going to be able to sell for years to come, and there's not that constant buying and selling. There's ways that you can take advantage of it too, but part of it is really the upshot to it all is it hinges on your ability to look ahead and to make these reasoned, more kind of sensible decisions rather than ones that maybe jerked around.
And I think maybe being able to moderate, all right, what is the future going to look like? Yeah. Because you're absolutely right. It's the reaction to inflation and the assumption that inflation is going to either continue or not going to continue. But, we've talked about this quite a bit on the Gray Report, is the concern of, and the acknowledgement of, some buyers over speculating in assuming that inflation will continue forever. Yeah. At these high rates, and not growing their expenses at a similar rate, but they're growing, the rents, 6 to 10% every single year organically. Not they're forcing, they're not fixing the place up. We're just going to have record inflation. Yeah. And if that's the case, that can push things forward in a direction that's just too far.
Yeah.
and get out of
Well,
whack.
and that's another thing too. Is there's a difference between being prepared for the worst and only preparing for the worst, and then kind of leaving opportunities on the table and maybe even losing money because you're taking things in the wrong direction.
So, this is just fascinating because I'm trying to find the type of economy where multifamily just does horribly, and it's supposed to be in a deflationary, really deflationary economy, which we were in essentially a deflationary period over the last 10 years. I mean, it wasn't negative growth, but it was a lot of deflationary forces, very positive growth, and multifamily did great over the last 10 years. But stagflation, and we know in an inflationary environment, multifamily performs well, but in a stagflation, which is kind of a made-up term, I know, that was coined in the 70s.
Yeah, it's
multifamily's on fire. It's good then, because I guess they're saying that. So, but stagflation basically means there's high unemployment, but there's high inflation. And we're not seeing that. We're seeing record low unemployment, although low unemployment but low job participation rate. Thanks, baby boomers, for retiring. It's fascinating, and it makes sense, I guess, because you're still able to. I don't know if the general rule is if the economy's not doing good for anybody, it's not going to be helping multifamily. Are you going to get through? It's going to be probably better than most other asset classes you're going to be in, but it's not good for anybody.
Yeah, no, I think that was that's a good point, and what. And we won't have time to really dig into all of this here, but
well, we're going to have Jonathan and Noah on though next week.
Yeah. So, the real questions that I am getting at is what is there? What's the kind of catch? What are the situations where you should be? The things that you kind of should pay attention to. I think yes, the 10-year, an expanded view of inflation is worth paying attention to. But is that more of a is that more of a message of like look long term, or are there certain indices? Like it seems like interest rates are something they're watching a little bit closer even than the monetary policy decisions, which is something actually different than I was talking about last week, how, raising interest rates, that's going to be bad, but it's raising inflation that you really got to, that has maybe more serious implications.
Well, now there's all the talk of people saying, we got low unemployment, but we need wages. We need wages to rise. And and all these people who have been invested in assets and stocks and real estate, they're doing so well. They are the ones who have benefited from this inflation, but everyone in the bottom quartile has not. And let's keep this thing running hotter so we can get wages going. But the problem with that is, then you get into this whole wage price spiral, and the whole reason why everyone's lost purchasing power is because of inflation. I'm not a full gold bug, but sounder money might make more sense than just spending money. The other factor that's at play, and I know we're talking a lot of macro, but there is a lot of attention on it, is fiscal policy. There's no more fiscal policy that's going to be happening. I forget which senator it was. He's the Democrat. It's 50-50 Senate right now. Nothing's getting passed.
It's either go big or go home,
nothing's happened. Nothing's going to happen. It's small things, super bipartisan. Maybe they'll get something that's, what they do pass. You'd be skeptical when everybody agrees. Be skeptical.
Yeah.
But they're not going to get it. There's Build Back Better. Build Back Better getting done. There ain't no new housing policy. There ain't going to be a big new spending bill. It's not happening. There's no way that it's going to happen with Congress in an absolute deadlock.
In the deadlock,
Republicans most likely will take over the House and or Senate with a Democratic, president. Things aren't going to happen. So we're not. Sorry. Long story short, fiscal policy has gone away.
Yeah.
For the longest time, the Federal Reserve has said, Congress needs to get involved. Fiscal policy needs to be there. You guys need to take action, which is kind of BS. But everybody's got their place, I guess. Yeah. But now the Federal Reserve says this is solely on us. If we want to move the economy, we can't rely on the U.S. federal government. It's solely in our hands and our responsibility. And at the same time, they're examining what is our true responsibility at the Federal Reserve. Is it maximize employment? Is it stable pricing? Or is it also climate change and race relations? And social things. And what else can we fix while we are this private organization that can audit, can understand exactly what's going on behind closed doors. And again, that's all fine.
Maybe the Fed will build the future that we all imagine.
They probably
that we're
will.
all happy with.
And I think they do get it right a lot of the times, but just they can get it wrong as well. And again, I don't have a problem with the Federal Reserve. I just wish there are multiple central banks, but I just, outside of the scope of the Gray Report, Matt, the competing currencies are interesting. That's why cryptocurrencies are kind of interesting to me. But it's more of having a monopoly on the money supply.
See, and this kind of ties into the this other article, that this research brief by Marcus and Millichap on the real state of the economy right now, and it's not doing too bad when it comes to employment, especially.
Thank you for pivoting.
No problem. But it is true that there is a lot of people that are thinking and relatively anxious a little bit about inflation or monetary policy and the disruptions that those may cause. But it's worth kind of putting that in context. And the job's not done yet. Basically, if the Fed has that expanded role and has that iron grip, then maybe they haven't really sensed that their job is done yet.
That's exactly what we're thinking. That's what's being discussed is like, what is our true role here? If we're trying to just increase everybody's wages, what can we do? And what are the risks? What is a higher risk? Do we? Yeah. And if you look at that context of risk assessment, risk mitigation, I think there is a higher risk to raise rates quickly, to go hawkish, even if that's the right thing to do.
Mm-hmm. Yeah.
But the Fed's already, knee deep in it, really waist deep in this. It's not like they're like, oh, we started tweaking, we're going to level up. No, you've been involved.
Trying to land a plane.
You've been in the
Let's
kitchen
just
since,
refuel midair. Let's not land the plane.
So they're saying, hey, we're already in this. We caused the problems. We need to be the ones that fix it. That's what's
and again, there is and another way of thinking is there's still work to be done, and the economy has recovered. The open question is whether it would have recovered with or without the added liquidity, and whether that's creating a problem in the future. Yeah. But this report from Marcus and Millichap does make the point that and their dominant really point is that the economy is doing well, growth is continuing, and the latest jobs report showed 467,000 new jobs created. The unemployment, now you're going to hear reports and articles that say that the unemployment increased, but that is only it increased from 3.9% to 4.0%, and that is also with the labor force participation rate going up 3 times as much from 6.9 to 61.9 to 62.2%. Basically, more people are out looking for work. That kind of offsets a little bit the unemployment rate. And it looks like from the face of it, there's more workers, a growing economy, and signs that really the Omicron wave didn't leave as much of an impact, didn't really undercut the growth of business like we thought it might. But apart from that general message of growth, because I always got to poke holes and stuff, there are still some undeniable elements of this economy that are still behind and still recovering. Yeah. Now, that could be a point in someone saying there is uneven growth, we're leaving people behind, or you could take a more positive spin on it and think that there's room to grow, that these things will grow, they're not being left behind, and we still haven't seen it yet. Yeah.
The baby boomers that retired aren't coming back out of retirement anytime soon. The homes that they owned are 30% more valuable, and their stock portfolio is up 40% over the last 2 years. So.
See, and that's whenever I see reporting on the Great Resignation, people talk about lifestyle changes and changes in priorities, and I just realized what was really important, but they never... But not a whole lot of them. Now, I haven't gone and read encyclopedia.
Those make good stories.
Yeah. But I do think the context of what are people worth to begin with. Are they able to quit? Because if they're able to quit, then their lifestyle changes has a whole lot to do. Maybe their priorities can afford to be changed. But if they, if your back is against the wall, then that doesn't make sense.
And isn't that a healthy thing? If people,
I think so totally.
If a lot of people don't feel as though they're not in survival mode. They've got options. They've got some freedom. That's great. Yeah. I mean, that's what we should all want. And that's where, this economy, is it screwed up in many ways and confusing? We don't understand, and it's volatile 100%. I just have this feeling that we are in the kind of we're doing pretty good, actually.
Yeah.
There is some really solid fundamentals going on, and all these baby boomers getting back, baby boomers retiring. That just means other people are going to take their spots, moving into management positions, and people are going to be making some more money who hadn't been able to make more money.
Yeah.
It's a lot of it's going to be a lot of millennials who are finally going to be in some decent earning years, which we kind of got screwed over, for one reason or the other, great financial crisis and whatnot. And that's going to leave some opportunities for the Gen Zs to hop in there, and then as they're graduating college, they need a job, and it's not just going to be we need entry level positions, but there's room for advancement. Yeah, because there are all these rooms along the ladder.
That's true,
and I think that's good. I think that we are improving logistics, supply chains. We're trying to. We've had all these challenges. We've created all these solutions. We're becoming more productive. I think these are all good things. And again, and I think like you had mentioned earlier, Matt, it's like acknowledging that there's a black swan circling above always. But point me to the piece of data where it's like, no, this is things going down tomorrow. Acknowledging that it could, because we don't know everything, but we're looking forward every week.
Yeah.
Now,
there are people that never stop saying it, and I've kind of tuned them out.
It's fun listening to Peter Schiff. Everyone, he believes what he says, and that you got to respect the guy for that. And you have to wonder sometimes. We're looking at this Marcus from Millichap report. They do great stuff. We like all the people over there, but the brokers, the research team, John Chang and Greg Willett. But it's like they're in the business of selling properties.
Yeah.
Okay. So I'm gonna be a cynic, and I'm looking at this, and this is all I'll tell you. And this is why. This is trying to also show like we're not just spouting this. We're not just reading this stuff to say real estate is good. You should buy in real estate because we're here investing in real estate alongside of you. We're trying to figure this out figure out where the truth is. Could they be saying we need to sell some? What are the three asset classes that have been hit hardest? Retail, hospitality, retail. What are they talking about? Turning around. What needs a shot in the arm?
Yeah.
It's retail, maybe not as much. Retail's been doing better, but hospitality and office. Recent hiring bolsters long-term outlook for office properties. That's convenient for someone who's trying to sell a lot of office properties. Are they wrong? Not necessarily at all.
Well, and the title of that chart that they have there is like, I was like, wait, what? Because the thrust of their whole article is about how, we're recovering so much. But then it's a quick reminder. It says certain sectors already surpassing pre-pandemic levels. Like, it's already doing this. That was 2 years ago. It's been 2 full years or more. And some sectors have not come back to their pre-pandemic levels. So that paints a little bit different than, I know they're cheering on the sectors that have already surpassed, but it sure shines a light on a lot of those sectors that have not surpassed their pre-pandemic levels.
And so, for example, just starting for the ones who are still not back to pre-pandemic, and this is headcount for employment. So natural resources and mining, still down 15%. I guess no surprise. We have a material shortage, energy shortage, and I forget who made the quote. I want to say it's one of the Fed governors. We have a molecule shortage. It's everything. It's just molecules. Yeah. Whatever it is, and for energy, for materials, we just don't have enough stuff to make the things that we need. And so when you see natural resources and mining down 15%, well, that kind of makes sense. Yeah. Leisure and hospitality down 10%. Government is down. That's fine. Education and services down 2.5%. Manufacturing down like 2%, construction down like 1%, and then everything else positive. Financial activities slightly positive.
Matter may not be able to be created or destroyed, but I think money can. That's my.
Is it real money, Matt?
That's right.
Is it real money? Is it just are we talking fiat here? But no.
So you can add a zero to the end of bank accounts, but.
Which is what the Federal Reserve does.
Yeah. But that point on the real ground level, when we're talking actual molecules, there's some room. There's some room for growth.
That's true.
There's some room for recovery, really.
Yeah. So. Yeah. Matt, we're gonna have to hold on. You're gonna have to keep me held back because there's just so many tangents that we could go on to. So many things are exciting. That's why we like doing the Gray Report. Let's get into this NAR report. It's the last report on the Gray Report for today.
Yeah, and we don't have to spend too much time on it. Only as almost kind of a reminder. Housing
it's not a good report, Matt.
No, not because it's not a good report, but because the sun's going down. As this report puts it, now it's no surprise for any of our listeners, really. They talk about the double trouble of the current housing market. And they talk about the two troubles, which are record high home prices and record low inventory, which may not be exactly groundbreaking, but at least it's a solid start. What I like, though, that they do is on the following page is compare housing prices and housing supply with median income and different. I'm sorry, the next one. Yeah. But down a few pages in front of that, they cover it in relation to median income and into different income levels. So they not only do they look at the average income for everyone, they look at, how many, what's the share of houses that people making $25,000 to $35,000 can afford, and it's 12%. And then what's the share of houses that if you're making 125 to 150, and it's 72%. Now they compare the numbers for 2021. And across all of those categories, except for maybe one or two, houses have become less affordable or equal, but definitely not more affordable. The number, it's more affordable. You got to go back in time to get a better housing.
Yeah, so just for an example, Matt. So on the income levels 50,000 through 75,000. Back in 2019, about 40% of 40% of households could afford that, or 40% of the listings, someone making $50,000 to $75,000 could afford. So, you're making $50,000 around the median income, $50,000 to $75,000 a year. You could afford about 40% that hits the market. Now, fast forward and then go back in the past couple months. In 2021, only 34%. That's 6% difference. But look at the listings, the number of listings each household can afford to buy. This is the biggest difference to me. So not only can you not afford it, but in 2019, in that income bracket, there were about 400, and this is nationally, I assume, there's 450,000 homes, listings that you could buy. You could buy a house today, well, a couple months ago, in 2021, for that same median income, there's only 165,000 homes.
Yeah, so 7, maybe sometimes you'll get a 6%, but the number's double or more than double.
So number of households per listing, again, back in 2019 for the same income bracket, there's 46 households per one listing. Yeah, now it's a tripling in 2021, 125 households per listing.
That's the most dramatic. It's so it's almost like really starkly shows the supply is down way more than the demand has gone up.
Yeah. And so, and just looking at maybe another income bracket, so let's look at, what's another big change, Matt? Maybe let's look 100 to 125,000. Back in the day, in 2019, 71% of the houses that came out, someone making 100 to 125K, you could afford 71% of the houses that were on the market. In the entire nation, there were about, call it 800,000, just under 800,000 listings. There were 14 households who wanted to buy them for every one. So, maybe you have to do a little hunting, but not that bad. But now, fast forward to 2021, only 63% of households can even afford a home in that range that you can buy. And of all the listings, you can afford to buy 63% of them. So you can buy more than half. That's good. But there's only 306,000 listings in the United States. 36 households per listing. Good luck.
Yeah, it's such a stark difference, and it's very crazy how the numbers have changed so much in the past 2 years, especially when it comes to supply.
Absolutely, supply and demand, and again, it's a confluence of a lot of different things. It's demographics, the pandemic. It's not building enough. But this is a really good report because we've been saying this, a lot of anecdotes, but putting some real good numbers with it. again, we've been talking about this concept, but to really look at it in
Yeah.
detail.
Well, this is the.
That's how these bidding wars be. That's why the bidding wars.
But
happen.
go back to molecules. The housing, the stuff isn't there. The houses, the physical houses aren't there. And that has come out of swing much more than, the imaginary price that people are willing to pay for it, which is crazy. And it represents a more fundamental, that's a more fundamental of the economy that you can expand out to a trend for 5 or 10 years, much more than, the speculation of a heated housing market.
Mm-hmm.
There are real facts and real, boards and timbers that aren't in place and that's what's going to really characterize the market, I think.
It's true. It's physical stuff that has to be there. And it either exists or it doesn't exist. And this is where someone comes and says, oh, interest rates are going to rise by 50 basis points, a percentage point. The market's going to crash. You literally have hundreds of people going after the same listing. You don't think that one of those people are going to step up and pay a little bit more money when everyone's been bidding 20% over ask?
Yeah.
So you think that 50 basis points of your interest rate, when they want it more than anything because it's going to be their home, they're not going to pay it? And all these people who haven't been able to buy a home for the last 2 years, they think they're going to just sit on the sidelines. If prices actually do decline, everyone and their mother has been saying, I'm waiting for the housing market to cool down before I can buy a home. I'm looking for a house. I'm just waiting.
Yeah.
Well, now, sure, some of them are going to get scared, not going to do anything. But why would you think that just a little bit of move in the interest rate, coming back to what Jonathan or Noah have been saying, you're not going to crash the housing market? Now, what John Chang said from Marcus and Millichap, though, if it's beyond 50 basis points, beyond 100 basis points, if we see rates moving 150, 200 basis points, then all bets are off. Because it's not even the housing market. Sure, that cools, but you're just having a cooling in the economy in general. But that also means that we have some insane inflation going on for that to occur. And again, talking about the risks, the Fed hesitant, doesn't want to screw the economy, that they are the only ones that really know how to screw the economy. They'd rather see wages up and up and up and up.
I really liked this because it also compared not only between 2019 and 2021, it also talks about different regions. And it ranks them on page 14 according to affordability. And you'll see different regions. Now, I think that it isn't to the point where people are always going to go to where the houses are more affordable. I think there probably are communities in decline and some growing communities. And so you have to really look at the full story. And this is more of a snapshot. But it's still, when you're looking at cost of living, it's not just the price of homes, it's the median income in there. And this collection is if you look at it, there are some places like Birmingham, Alabama seems to be fairly affordable. And it could, if that's in the South, it's in the Sun Belt, maybe you'll see an influx. It's a migration towards there because it's getting to the point where if people can afford to live somewhere more cheaply and they like that area, then maybe they'll move.
Well, I mean, we're repeating some things from previous episodes, but there's kind of three major migratory trends. We'll throw a fourth in, although it's kind of related. But it's family is the biggest one, which can relate to family, retirement, and value. I'm going to say 5. That's too many.
That's right.
Family, value, which includes jobs and economics, going there for, economic reasons. So let's just include that, one. And then lifestyle. I guess lifestyle is retirement. So let's keep it to 3.
Yeah.
So family, economics, and lifestyle. And lifestyle including people retiring, they want a different life. They don't want to deal with the winters. They want to move somewhere warm. So that makes sense. You're going to move down somewhere like Birmingham, Alabama, or Jackson, Mississippi. Although I don't see those listed as the top retirement destinations, but they could be. I'm not like a retirement expert by any means. But then a lot of these are, a handful of these are, I would say, more or less somewhat distressed markets, cheap markets that you can get a high cap rate in. I'll say that most, not all. I'm thinking the Toledo, Ohio. Detroit is so balkanized. There's great parts of Detroit, and there's other parts you probably don't want to go to.
Yeah, so that's my
Akron,
from a perspective of investor, are these markets affordable because they may be on the downswing? Is this a brief blip and it's a real opportunity to buy low, or is it some kind of case where
you get what you pay for?
Yeah, or it's just going to stay stable. Like there's probably a reason why all of these are at that specific price point, but it is housing affordability I think is a huge part of market analysis, and so in kind of trying to tease that out I think is really
well. And there's a couple things to be thinking of from a multifamily investment standpoint. Also, one is you want to make sure that there's not a value trap, which we see. It can happen in a market, it can happen in a property of like, oh, this is just such a good deal, it's so cheap. Well, it's because it's not going anywhere. But then so that's the actual asset itself. But same thing with the market. It's like if you only are buying on cap rate, which I never recommend anyone to do. I mean, it can be like, oh, we're getting a good cap rate, but that gives you doesn't tell you much. I mean, gives you information. But if you're just buying the highest cap rate, again, it's a value trap. Well, we could maybe get to a high return. Yeah, but you're going to have a lot of problems, a lot of risk, and it means that nobody wants it. And no one is going to maybe want it when you go to sell it.
Yeah. So it's not just the price. There is a story behind everything.
What's going on here? And sometimes it's like it's just mispriced.
Yeah.
And there are markets where it's like the word hasn't gotten out. There's all kind of growth. These 3 major companies just moved in. There's 10,000 jobs being hired, but like no one's talking about it.
Yeah.
And that could be an opportunity. It's been depressed in the past. Things have changed. But just seeing cheap doesn't necessarily mean good. And I think more times you get what you pay for than not. But that's, again, why real estate is interesting. Investing is interesting is because if you can see the differences and you can exploit the inefficiencies, that's how you can make some money. And which is harder to do. Well, you can do it with stocks, seeing what's mispriced. But it's a much more efficient market and less opportunity for that. To make some money doing it. So
agreed.
Yeah. Matt, what's coming on in the next week over at the Gray Report, Gray Capital? Anything? Some
big plans.
Anything?
Some really big plans. Know? I can't announce it. It's too big for me to even.
Launching February 14th. From Gray Capital, open to accredited investors only, the Gray Fund. It's a stabilized fund of multifamily assets, primarily in the Midwest, all cash flowing, all in growing markets, secondary, tertiary markets. It's all the same strategy that Gray Capital has used successfully to acquire. We've invested in over 10,000 units at this point. We've got $500 million of assets under management. We're cranking out IRRs on average around 26%. I could live or die by returns. But in general, we are obsessed with doing great deals, making great partnerships, getting into good markets, and making great investments. We're raising $100 million over the next year, so we're going to go out and buy around $300 million worth of assets. We'd love for you to be a part of it, be on the team, go buy some great real estate with us, be part of the Gray Fund. Again, it's only open to accredited investors. So look in, make sure you are an accredited investor. But if you're like, hey, that sounds good to me, I want to hop on the bandwagon with Gray Capital. Hop on over to graycapitalllc.com to learn more. Again, if you are plugged into the Gray Capital ecosystem, you're getting the Gray Report, you're going to get emails about this, so don't worry. If you're at all kind of looking around at the multifamily space, you're probably going to hear about it because we're going to be shouting it from the rooftop as we're so excited about it. This is going to be a big step for the team at Gray Capital. It's a first of many steps, and we're really excited. But I also have to admit, we have so much going on.
It's true.
There's so much going on.
It's not just.
It's not just. So the Gray Fund, obviously a massive deal. It's gonna be huge. We're really excited about it. The team, we've got a great team. You can find the Gray Report. Did you know, Matt? You can find the Gray Report not only on YouTube.
I'm very pleasantly surprised.
So we've been teasing this for a while, but the Gray Report is now available wherever you get your podcasts, Apple Podcasts, Spotify, other places.
We got Google coming along too.
It's going to be on all the podcast spots. So if you're a podcast aficionado, a listener, a connoisseur of the finer audio elements, we'll strap in and plug Gray Report Podcast into your regular rotation. You'll be able to listen to these episodes because you're like, I don't have time to watch things on YouTube. I listen in the car. I'm working out. that's what the Gray Report podcast is all about. You can get a download of all of the market updates, research, and data just straight to your brain holes as quick as possible. But there's also, we're going to have some other cool content. There's an episode 0 that gives you a lot of background on me and Gray Capital, all that fun stuff. We got a lot of great interviews planned. We've got, like as Matt mentioned, we've got Jonathan and Noah from Berkadia. They're going to be breaking down all this inflation. These guys are really smart. They're going to be breaking down inflation, cap rate, way smarter than us. So they're going to be able to tell us where we're wrong and what we need to pay attention to. There's probably 5 other things to announce, Matt, but Gray Fund and the Gray Report podcast all coming out, all available. Check your local listings.
It's great. Well, we've got
Are
a
there
wealth of
local
good
listings
news.
anymore? There's probably local listings. Local podcast listings or Apple podcast listings or Spotify. Yeah. Well, Matt, this was a great episode. Went off on a couple tangents, but I think that's okay, and that's why we get paid the big bucks, right?
That's right, yes.
All right, have a great week. We'll see you next week on The Gray Report.